2025 was a big year when it came to tax changes. There was, of course, the one big, beautiful bill, which was passed back in July, and many of the provisions within the tax bill had taken effect as early as 2025. So, therefore, we're going to notice quite a bit of changes that are going to happen when we file our taxes in 2026. There are also going to be a number of effects that are taking place for pre retirees and retirees alike starting in 2026. I think there are three that are fairly impactful. Let's uncover what those are today. If we've not yet met, my name is Danny Sinowitz. I'm a CFP professional from Hyperion Financial. The first one are going to affect pre-retirees, those that are over the age of 50 and also specifically between the ages of 60 to 63. Let's cover what they are. The first one is actually a change that took place beginning in the tax year 2025. And that was as a result of the Secure Act 2.0, which actually increased the amount of catch-up contribution that an individual could make if they're between the ages 60 and 63. So as you can see here, these are some of the catch-up figures that take place for those between the ages of 60 to 63. The increase in the catch-up contribution can allow you to defer more of your income, can help set aside a little bit more growth and allow you to save a bit more as you get closer to retirement. There are many reasons why I think some folks want to take advantage of this type of opportunity. And I do think it's something that you should continue to at least consider moving forward. However, there's a big change coming in 2026 for higher income earners. And that is the fact that contributions that are going to be considered catch-up contributions, if you're a higher income earner, will need to go into a Roth account rather than a pre-tax account. So why is that important? Well, for many folks who are higher income earners, they want to delay or defer as much income as possible. And one of the best ways to do that is by contributing to their 401k, their 457 plan, their 403b plan that is perhaps going to be pre-tax. It's a way in which you can defer income until you're ready to turn on more of an income stream in retirement, perhaps when you're going to be at a lower tax bracket. Now, again, every taxpayer is different, so this may or may not be applicable to you. However, something that's changing is that catch-up contribution, if you earn more than $145,000 in the prior year, is going to need to go into a Roth account. That Roth account contribution, as many of you may know, is going to be considered an after-tax contribution, meaning that the contribution that you make will not be able to defer income that you currently have. So as a result, if you're making this contribution, and you've done this in the past with the catch-up contribution, which you've previously been able to defer, will no longer be able to be deferred. Now, it's the catch-up contribution, which is going to be considered after tax or have to go into a Roth account in order for you to contribute to this. If you don't have a Roth account contribution at work set up, or a Roth 401k, Roth 457, or a Roth 403b plan, and you made over $145,000 and were considered a higher income earner, you may need to find an alternative source to actually contribute to. So being that this is not going to be an option for you, you may need to consider contributing to an after-tax account or setting something up on your own. Now, if you made under that $145,000 a year threshold, rest easy, you're going to be unaffected. If you're also self-employed with no W-2 income, you're going to be unaffected. It also doesn't affect Roth IRAs. So again, I think that's something that we want to be clear on. If you're contributing to a traditional IRA or Roth IRA, that is going to be irrelevant. It's going to affect employer-sponsored plans, like I said, for example, 401ks, 403bs, or 457 plans. Again, what I also want to make sure that we understand is that the base contribution itself is going to still continue to be allowed to either be pre-tax or Roth, whichever your preference is. However, we also want to make sure that we have a plan, if you were saving more, for what to do with that excess amount. Now, the question of whether this is actually bad or not, I think is a fair question to ask. It's certainly not a good thing if you're looking to defer income, if you know for certain that you're going to be in a lower income tax bracket in retirement, because the more that you defer while you're a higher income earner and then you can collect at a lower rate in retirement, it's typically not going to work out well for those folks. But if all you have are pre-tax assets and that's all you saved into, this can be an opportunity for you to consider some tax diversification and looking to save either into an after-tax account, perhaps if you qualify and you're eligible, to consider a Roth IRA contribution instead. By doing this, it can allow you to have some after-tax or some Roth savings instead, which can actually come in handy and add flexibility to your plan once you reach retirement. So yes, it'll sting a little bit to lose that contribution amount that you can consider the catch-up contribution, but it could also work in your favor down the road. You just want to make sure that you have a plan going into 2026 for this. The second big change is going to affect charitable givers, and I think there's a little bit of positive and negative to this. The ones that are going to be positively affected are the 90% of taxpayers who utilize a standard deduction. If you're charitable and you're utilizing the standard deduction, you now have a benefit that can work in your favor. Starting in 2026, you now have the ability to utilize a standard deduction in addition to a charitable deduction. And this charitable deduction is going to be $1,000 for single filers and $2,000 for married filing jointly filers. So before, when you were probably making charitable contributions and utilized a standard deduction, perhaps you would have included those at tax time or handed them to your CPA or accountant. They would have disregarded them. But moving forward, starting in 2026, this is a provision that is in place now where you can actually take advantage of charitable contributions and still claim the standard deduction, and you get a little bit of a break for being charitable. So while it's good for those that are taking advantage of the standard deduction, itemizers are going to take a little bit of a hit with this. A new 0.05% AGI floor is now put in place for itemizers. There's also the cap for the highest income brackets, those at 37%, where you're going to be capped at the 35% deduction starting in 2026. So this can actually have an effect on, again, higher income earners who are charitable. Now, one thing that I think we want to make sure of is just how exactly this math is going to break out. So for example, if you contribute $5,000 to charity per year and you're itemizing your deductions, if you make $100,000, the new amount that you'd be able to deduct as a charitable contribution is $4,500. So if you take a look at the math, $100,000 has the floor that's introduced at 0.5% of $500. That floor then will take off $500 from your charitable contributions, leaving you eligible to take advantage of a $4,500 charitable contribution, which again, if combined with your mortgage interest, your state and local property tax, other things that you can utilize for itemized deductions, can potentially allow you to take advantage of that itemized deduction moving forward. However, for those that were itemizing and that were charitably inclined, this is going to be a hit for you. There's also the inflation adjusted tax brackets. What we're going to show here is there are going to be single and married filing jointly tax brackets, which reflect ordinary income. And as if you recall, ordinary income includes things such as your earned income. It includes pre-tax IRA distributions, pension income. Perhaps it could include Social Security benefits. There are many different sources of ordinary income that you could be bringing in. Others could include interest on your savings account, short-term capital gains, or even if you win the lottery. That's going to hit your ordinary income tax brackets. And as you can see here, it's going to start at the 10% and go to 12, 22, etc. What we did confirm in the one big beautiful bill is that the new percentage brackets are going to be made permanent, quote unquote, which just basically means it's going to take a future act of Congress before these rates would expire or sunset. We also have the standard deduction increase that takes place for filers as well. Whether you're a single filer or married filing jointly filer, you can take advantage of that standard deduction, and that'll also be income that is taxed at a 0% rate. We do also have the enhanced senior deduction that is available for taxpayers who are over the age of 65 and who are under $75,000 of modified adjusted gross income as single filers and under $150,000 if you're married filing jointly. So again, that additional $6,000 or $12,000 if you're married filing jointly deduction can be something that can allow for more income that you're able to receive, that you're able to do so in a very tax favored way. Something else you want to keep in mind with that is if you go over those thresholds, it's going to be phased out at about 6% for each dollar that you make until you're phased out entirely. You're also going to notice that the capital gains brackets have had a little bit of a bump there as well, which again is something to take advantage of, specifically at the 0% rate if you find yourself in a lower tax bracket. So being able to recognize capital gains, long-term capital gains specifically, at a 0% rate could be utilized if you plan your taxes accordingly and do so in a smart way. Lastly, there's also going to be the IRMAA thresholds, which are going to affect you when it comes to your Medicare premium surcharges. The income that we're going to be looking at here is 2024 modified adjusted gross income, but it's going to affect your 2026 Medicare premiums. There's two things that we want to look at with this. Number one, the Medicare Parts B and D premiums and the surcharges that go along with them have gone up. So that amount that it's bumped up, you can see here in the chart, is something that you're going to need to keep in mind will take place. Even though there was a Social Security cost of living adjustment, the Medicare premium surcharge could also go up there as well. So how much of that Social Security bump you're going to feel will depend on what level your Medicare premiums are at. The other thing that we want to also look at is the fact that the income adjustment has gone up as well. So for the first level, it goes from single filers who would have been at over $106,000 of modified adjusted gross income to now over $109,000. So the 2025 numbers have been adjusted now in 2026 for about a $3,000 bump for a single filer. Those numbers are doubled for folks that are married filing jointly. So keep in mind for Medicare premium surcharges, while the Medicare's Part B and D premiums do go up each year, the brackets also go up as well. Being that this is going to be some of the things that are going to take place in 2026, I think it's important to make sure as you head into the new year that you're aware of these changes and several other that are going to take place. Another big one that's going to take place is health insurance premiums. So if you are prior to your Medicare eligibility, perhaps you're under the age of 65, looking to retire early, and let's say your employer either doesn't offer health insurance or you need to find a different solution from an employer-sponsored plan, I think it's worth checking out this video right here to get an idea of which options are best available to you.